score is both purposeful, attached to a purpose, which is simple for you, or it could be generic across all the spectrums.
Well, so typically a credit score will be generic. Like
Okay.
anything you'll get from FICO or Trusting Social, like anytime you buy a credit score from some vendor, that's meant to be a general purpose one that will work across all of their customers. Whereas internally, you'll typically build a score on top of that plus other things, and that'll be used for your own lending.
So if I'm running my own startup, doing my own lending, I would probably purchase a score from you, and I have to do something on top of that.
And you'll probably purchase something from Sybil, and then probably you'll look at a few other things that might be more special purpose for you.
So irrespective of whatever I do, I still have to. All the credit score becomes input to my own personal.
Typically you'll want to do a little bit more than just use the score without any modification. So here's an example. A consumer unsecured loan is when you lend money and you hope the customer pays it back, and if they don't, you're out of luck. Whereas there are secured loans, like for instance a home mortgage, people put a lot more effort into paying those off than consumer unsecured, because if they don't pay that off, you can eventually repossess the house and they have to find a new place to live. So they'll put more effort into paying off a home mortgage than they will into some consumer unsecured. In the US, medical loans are some of the first ones that are written off, so people will typically try to...
So I want to put in the context of Australia, because in Australia, student loan is also a big issue in terms of policy. So in Australia, the government runs the student loans, and basically the money is coming from government funding. And you are, basically you won't need to repay the loan if your income after graduation is less than, let's say, 50,000 Australian dollars per year. So, and the thing is, student loan in that case is a bit different because they are managed by the government. So the ATO is gonna manage your income anyway. So they're gonna know how much you earn per year, and they enforce you to pay back that through the tax.
So the reason why I asked about student loans is because there's no such concept of guaranteed student loans in India, right? And there are startups which try to sell loans to students, right? And they get into all kind of trouble in terms of default. So one of the stuff that they keep asking about is like, if there had been no history of these guys, there's no jobs, no sets, nothing, how do you even give them a loan? Would alternate models work, or is it like, I'm not going to give you a loan?
Well, okay, you still have some predictor of what earnings are going to be.
Okay.
So the question is, so the two questions are: will the person earn enough to pay it back, and also, are they likely to do so? So, given this, you can still keep in mind, like any loan you issue is across a pool. Some of them are going to go delinquent, and you just have to figure out the interest rate to charge the remainder so that you can make up whatever you lost. So, so what you could do here is, for instance, a bunch of IIT grads are probably going to make pretty good money. Pune University, probably a bit less. Okay. Similarly, there are regional differences in repayment rates. Like some cities and some states have much lower repayment rates than others. So you would probably, if you happen to be in one of those areas, you would probably charge a higher interest rate or just not do business there. And you would probably observe patterns across colleges as well once you actually have some historical data.
Do you see these kind of problems in Vietnam? Because the reason why student loans was important for me is because there is not much prior data, right? And there is a distinct unserved community in some of the developing countries. So do you see more use of alternate data sources for them compared to other?
So in Vietnam, our business is not only focusing on any particular customer group and any particular segment. And we haven't looked particularly for student loan in that context.
Okay. But so then let's move to the second part of it. You have any other questions on credit scores before we move to the alternate data sources?
I had a question.
Yeah, please ask.
So how standard is the 300 to 900 range? And I've always been curious, is the credit score sort of like linear, or is it something like normally distributed? Would a large percentage fall in the middle, or is it something like, I hope you got my question.
Yeah. So, I mean, I can tell you what the only place I've seen data on this is FICO, and even that is typically only for specific use cases. But typically, like for certain specific use cases with FICO, it will be kind of a not quite normal, but like a bit fatter version of normal. I mean, the 300 to 900 is you could easily make it 0 to 1. They figured 300 to 900 was easier for consumers to understand. That's just marketing. And it's typically a smeared out normal. As far as the applicants go, like where that normal is centered is to a great extent based on your marketing, like who you're marketing to. And then, like, put it this way, if your marketing is targeting a bunch of poor people with a lot of, who like lose their job a lot and just don't feel like paying the bill sometimes, it'll be a normal closer to 300. And if you are targeting like a bunch of richie uppies in Greenwich, Connecticut, it'll be pretty close to 800.
Yeah.
So you were saying it's simple that ultimately you want to have your own credit score for your own loans. And so you have your own predictors for whatever signals you have. Do you find the civil score still has predictive power, even when you use your own signals?
We have actually found traditional credit scores don't add very much to what we already have. In the past, it's added a little bit, but it wasn't like worth the extra engineering effort to keep it, and at this point, we don't use it at all.
So, whatever credit score you come up with is limited to whatever data sources you have.
Yes.
So there is a lot more data sources outside your control.
Correct.
How do you account for them?
I mean, any data sources we don't have in our system, we obviously can't use.
Yes.
But the thing about our data that makes it well suited for our purpose is that typically our data is based on things like transaction history on merchants where Symbol is available. So typically speaking, we've experimented with alternate data sources. A lot of them, like that are very disparate from this. A lot of them, we get a lot of data on people who never even use Zomato and therefore never see the Symbol button, or never use Book My Show, never use Dunzo. And so if you're not on Zomato, Dunzo, Big Basket, or one of the merchants Symbol is on, it doesn't matter how great or how bad we think you are, you never see the button and you never have the opportunity to use it.
Not all of this data is credit data. Big Basket or Book My Show, whatever data you listed down.
Yeah, most
Not
of what
all
we use is
them
not.
are credit data, so you still rely on them to come up with a score for credibility.
So we actually use very little credit data. We use almost entirely other things. But some of it is financial in nature, but not credit. But the point is, our data is also tuned to our use case. So every time we experiment with other data sources where we just go out and get data on people separately, unless we're just getting data on people we know are also customers of merchants that Simple is on, it doesn't help us. Like, we don't even know if it would work or not because those people don't wind up using Simple, and therefore we don't know.
Let's say you don't have any person who have payment history with Symbol. So we have to accept the money that we lose on some of the bad customer at the first point as a cost to get the data. So we have to invest into that to obtain the data. And that is the same situation with trust in social as well.
So the cold start problem can't be solved without spending a lot of money earlier.
It doesn't have to be a lot necessarily,
But some money.
Some,
yes.
yeah. But compared to the whole running cost, then that is still acceptable.
So there are some scenarios where people used to change their identity, right? They defaulted and they took a different number, changed the name, and they again do the transaction over some platform, and this is like genuine. So how do you track that is the existing user and is changing the identity?
I mean, I can't really say because then they might figure a way. Someone might be listening.
Yes.
Okay, so the general rule is you should not push them too hard on their trade secrets, but generics are okay.
The thing is, it's not that we are not willing to share with the community, but if we say something, then people who are, want to do that kind of things, they will know the way to hack the system. So that's the only thing.
Okay.
There's hundreds of thousands of people out there who really want to steal our money. So we have to be a little quiet about these things.
Yeah.
Okay, fair enough. So let's come back to the hard one, which is, do you employ collection agents?
We have our own people who call up and say, please pay your bill, and you get some spam messages, but we don't like send anyone to your house to take your furniture if you don't pay.
Okay.
Although I think some of the merchants we're going live with involve rentals, so they may wind up taking your furniture if you don't pay,
Okay.
or your TV or whatever it is they rent.
Okay.
I don't know exactly how they work if you don't pay the bill there, but it's along
Okay.
those lines.
Fair enough. But you said Trust and Social used to do credit scores, right? But are you also trying to go into the model where Simple is going, where you're just putting your own money and lending?
So the
Right, there is this paradigm, FICO civil. The banks and how they operate have changed drastically. Why hasn't that shift come sooner? As far as I can tell, there's no company that's nailed it, that's convincingly used machine learning for credit scoring and got a competitive advantage from it.
I mean, there's quite a few companies that have done that. So Lending Club, Klarna, Afterpay, WePay. Those are some very large, those are some billion-dollar companies that do this. I'm not 100% sure if the WePay lending line is bigger than $1 billion, but it's close. There are several more in Latin America whose names I don't remember off the top of my head. So it certainly is out there. Also, what happened is a lot of consumer unsecured via alternative data has started actually going through banks. So Goldman Sachs discovered there was a ton of money in this, and now banks do it. And that's what Goldman Sachs Marcus is about. So Goldman Sachs literally never ran consumer banking before. Then they discovered how much money there actually is to be made by doing this, and now suddenly I mean, it's a different brand, it's Marcus, but they do it. So I would say FICO is still there because FICO works. Like, no doubt about it, it is a great way to lend money, and it works well. So people aren't going to throw away something that works, but at the same time, the alternate stuff is covering use cases that FICO does not, and as far as I can tell, it is working.
But it feels like just in all those examples, those were niche cases where people really developed their own model, and it might have just been because they had specific signals, like in your case, for your use case. What I'm struggling with is that you still have like the FICO paradigm, as you said, broadly it works, and the majority of people are probably relying on it for generic credit needs. Why haven't we seen like a more advanced way of credit scoring that's become its own paradigm, and not just for the niche use cases like Power Lending Club, etc.?
I'm not sure exactly what you mean by niche. I mean, these are double-digit portions of the market now.
so
No specific niches on or specific use cases that are not generic,
so
not generalizable.
So I think your question is about like why can't we have a generic kind of alternative credit score that works on all kind of problems, right? Is that your question? I think this goes back to the root of machine learning. Unlike a person, if you hire a person and assess the loan, to approve the loan or not, then the person can work in almost all of the loan that you brought up, right? But machine learning models is in a different way. It needs the training data, and normally the model can only work with the new data that's quite similar to your training data. So if your training data is, let's say, on a credit loan, then it may not be going to work in cash loan, for example. So that's why we have to build particular models for different kind of problems here.
I would also suggest that if imagine FICO had not come first, there would be a need for a thing like that. So suppose there are machine learning models that are currently used for alternative cases that are also as good as FICO. If FICO comes first, probably no one's going to switch to it unless it has some dramatic advantage. So there's sort of a first mover advantage. If FICO is there and you're as good as FICO, I'm just going to stick with FICO and except in those cases where FICO doesn't work. So that plays a role as well. And like I said, FICO is actually pretty good. It's hard to beat. So when you have that level of data. it's much easier to beat when the data is missing. And that might be also why, the alternative stuff is only used when FICO is unavailable. But also, like to squeeze out basis points, many banks are in fact incorporating alternate data on top of FICO and traditional credit histories. Another thing that is a little bit tricky is that in the US there are significant regulatory risks to doing this. So specifically there are assorted laws related to fairness in lending. So I don't know how many people here are familiar with American racist history. So the thing is, if you actually were to plot delinquency rate versus FICO score, and you do this for each individual race, so you have Asian people, you have black people, you have white people, etc., you discover significant differences between these curves. And so that is signal that you could use. Now, a machine learning model might accidentally learn this signal, which is actually illegal to use. And in fact, they do. Like, my first foray into lending was this project where I was just trying to teach these guys how to do numerics in Scala. But then I noticed, wait, I can make this model a whole bunch better. And then I'm like, look, I made the accuracy go up by like 8%. Look how much more money you could make. And they're like, yeah, the regulators will never let us do this.
And what you were using ethnicity?
No, I was using some location stuff and a couple of other things that happened to be correlated with it. It was basically a machine learning model that just happened to pick up proportions of ethnicity in certain regions and a couple of other clues.
Indirectly, that was still an issue. That's interesting. So you were proxying for ethnicity, or arguably.
I mean, I had a very non-parametric model. I didn't know what it was predicting. I just noticed, look, there are these patterns. This thing seems to detect them, and it's like you train a neural network, and suddenly it picks out ethnicity from locations and which stores people shop in. I mean, certainly not with anything like 100% accuracy, but like 70% is enough to squeeze out more money. So they told me the regulators would just not allow this at all. It's a no-go. So that also prevents some of this from happening, at least in the US. I don't know what happens in Europe.
So could you say more about, and without, sorry, else has one, someone else has hand up.
Yeah. So, I mean, if you if you only lend out to people with good FICO score, you lose the money that comes if they pay you interest. So, if you want to you need to lend out to people with lower FICO scores. So, how do you optimize that?
Sorry, say it again?
So, if you lend out to, people with only high FICO scores, you lose out the revenue which you get in terms of late fee or in terms of your interest. To get that revenue, you need to lend out to people with lesser FICO scores also. So how do you optimize that? Or do you really optimize it?
So ultimately, there should not be, like if you're running a good loan portfolio, it shouldn't be higher you shouldn't be making more money off one cohort than the other. So let's say I'm loaning to one cohort with a 5% delinquency rate. I have to charge about 5.3% interest just to break even. Factoring in the cost of running an operation and making a profit, I'm probably charging like 7-8%. And that gives me about a 3% profit margin. Minus the actual expenses of hiring people and collections and so on. Now I want to lend to a group with a 10% delinquency rate. I will probably have to charge like 12-13% interest, and I'm still making that 3%.
Oh, so you change interest rate
based on the
segment you are
yes.
lending.
And so ultimately, unless a segment is underserved and you can charge excess interest rates, which is currently what's happening in consumer unsecured right now in the US and Europe, but that is, as more people enter the market, they're just offering lower interest rates to compete, and it'll get back to the same as everything else.
Okay. Anyone else? Yeah.
I'm just curious, is there any study that scientifically validates the credit score in the sense you have calculated X%, you paid Y% to B, but is there some kind of a randomized control trial that actually validates this?
There are actually less academic studies on this than you would expect, and they're mostly interested in something else. Like that validation is incidental, but at the same time, all the lenders that use this and don't go under is kind of the skin in the game test of whether it actually works.
Well, it might be a self-fulfilling prophecy, right? You're just giving
But if I'm wrong, I just lost money. Like, this is one of the things I really like about working at Simple. Like, I can ship code, and if it doesn't work, damn, I just lost a bunch of money. And if it works, the company made money. And either way, like, the proof is in the pudding.
Yeah, at least some A/B testing on the lower side of the score to understand who actually defaulting. Is there any true negative there or not?
Yeah, so most validation data sets will include this. So I don't know exactly what you mean by a strict A/B test.
Yeah.
Like what is a strict A/B test here?
So it will be like I know of the people of 100K are less than 400 score. I'm not supposed to send them lend them. However, I still go ahead to see like how many of them are taking money.
Oh yeah, I'm doing that right now.
Interesting.
Like I do that all the time just to see.
When you're using transaction history, if you'd be using, let's say, a large amount of data for a user, let's say something like a year ago. Now, recently, this recent history might be more positive. Now, but maybe because your model is using the old history and maybe not just like giving the weightage to recent, you might be actually not lending to some users who have now come, who are now in a better situation. They might have a lesser probability of getting it, just because they are earning better, probably. So, is that a situation that you might get?
I mean, now we're kind of getting into things we can't say that much about.
But do you adjust the score based on, do you gradually adjust the score factoring on time? You can say you do that setting the sequence.
Sorry, what are you asking?
No. That's a very high level point of what you asked. If you find a score for a person at a point of time, do you re-evaluate based on his patterns? And
Oh yeah, we reevaluate almost real time.
Okay. Just one more question before we move to the financial inclusion part. Yeah.
Question is that in terms of affordability and credit assessment, so do you see these as different items, or do you kind of club affordability as part of credit risk assessment? Just wanted to get your thoughts on affordability versus someone who has a very high, very low risk score. How do you kind of handle the loan amount? Those kind of things?
I mean, at Simple, we're not lending enough money that this really matters.
Okay.
Like, we're mostly your movie tickets and your lunch. So it's probably affordable to you.
Do you see anything to add from what you're doing?
So I think even though we are not in the micro lending at the moment as Simple, but our product is still kind of small compared to let's say a car or a mortgage home loan. Then affordability is not a very big deal here, I think.
Yeah. But I mean, I know that people who do things like car loans and home mortgages, they very much look at debt to income, stability of income, that kind of thing. So if you earn $1 lakh a month and you want to buy a 5-core house, no matter how good your credit score is, they're just going to say no.
Yeah.
Okay. So let's move to the second part, which is on the financial inclusion thing. You had done a lot of work on the alternate stuff because you said there is a lot of unbanked community in the Southeast Asia. Can you explain a bit more on that?
So basically, there are about, as far as I remember, there are about 1.7 billion people that haven't got any banking history or credit history. So basically, for those people, FICO score doesn't work, right? So what we do is we use alternative sources of data, and instead of for those people, instead of they are rejected by the bank or they are given by a loan with a very, very high interest rate, we distinguish them, distinguish the good customers from the bad ones, and we can still help the bank to give a better loan to those customers. That's how alternative credit score working. We are not trying to replace FICO, as Chris said. FICO is still working very well in some certain applications, let's say car loans or home loans. But in terms of smaller loans, like a few thousand, for example, dollars, then our problem is try to help in some certain groups of people that haven't got any banking history.
Okay. So it would be more accurate to say that the FICO, the target segment of the population that does have FICO scores, and the one that you try to do is complementary or exclusive?
It's a bit, I think it's complementary, because what FICO does is they will give you score anyway. If you don't have any banking history, they still give you some score.
Okay.
But it's normally very, very low, and the bank will not approve your loan or will give you a loan with a very high interest rate, because they don't know who is the good one and who is the bad one in that group of customer.
Okay. So we have a lot of usury laws in India which prohibit lending beyond a certain percentage. Okay. Do you have such laws in Vietnam and Southeast Asia?
I think I'm not sure about the Western countries, but I think most of the Asian countries are going to face the same problem. So basically, for some groups of people, especially like I want to put in the context of Vietnam, there are some certain groups of people who are running short of money all the time, and they need some cash flow to recover to their business. And basically, the bank are not going to give them the loan because they cannot, basically the bank do not have enough information to assess the credit worthiness of those people. So basically they have to run into the, I can say it's a kind of black market where they they borrow money from some people, and those people, they are willing to give you a loan without any property or anything to assure for the loan. But the interest rate is very high. Let's say they charge you 3 or 5% per day, something like that. And if you don't pay the loan, if you don't pay that amount, that interest is going to become the principal next day. So the problem is very, very, and it causes a lot of, it's like people will be trapped in debt, and they can't pay back the loan anyway. So the Vietnam government, they try to have this kind of issue, so they want to push the bank to give the loan to those people, but they haven't got a clear policy how that is implemented yet.
Okay. So what alternate sources of data do you use for these people?
So I think it's running into a problem that I can't review much, but in Trusting Social, we use telco data and other sources of data like social media, anything that we can get from the customer online, and we also have our own platform, our own app, where let's say if you want to have a loan from our company, you install an app on your phone, and we are getting consent from you that we're gonna collect a few items of data from your phone usage, and we can use that to predict your score.
Okay. How reliable are the predictors? Better than zero or?
Yeah. So in terms of performance, I think so far in the markets that we are working on, the banks are giving us quite good feedback in terms of performance. At least better than what they're doing if they don't have our score.
Okay. So you have a feedback loop about the loan performance with your lending institutions?
Yes, we have to run this back test dynamically with the banks, and to assess the performance of our credit scores.
Okay. So when we start about the machine learning cold start problem, okay, you solve that by basically getting data initially and prepare to write to a certain amount of losses. So once you get to that problem and you start using alternate data sources, then you need, for the model to perform better, you need feedback from the underwriting institutions about how the loan has worked. Right? That's how you get better.
Yep, it's kind of a loop. So we first we have to do the cold start, and we obtain some training data, and then we based on our prediction model, we give the loans to some certain customers, and then we have obtain feedback in terms of loan performance, and we use that as an extra data to improve our model.
So when you do that, is the model that you underwrite the lending institution, or you are just providing the data for fees to those lending institutions? What's the model you use?
So for the current business model, because we partner with the FI, so we just act as a provider of the score, and the financial institution will decide whether they approve the loan or not. But in our new platform that we just launched in Indonesia, we will decide whether we approve the loan, because that is basically our lending platform.
Any other questions? Keep asking.
So let's say we have 1 to 10 alternate data sources. Now the problem arises that for some customer we have 1 to 3 alternate data sources. For some customer we have 5, 6, 7. For some customer we have 2, 8, 9. Now how to do the combined decisioning or how to make a model, because you can't make a model on all the permutation combination. So how you use all 10 different alternate data together to do the credit risk decision?
So I think now we have some models that are quite robust in terms of dealing with missing data. So basically, if you have that kind of situation, I think we can still use all 10 data sources. And for some certain customers that miss some certain sources data, we accept that as missing values.
Sometimes one particular data source, let's say credit bureau data source, is so powerful that it won't let other data source to come up more significant in the model. That in that scenario,
I think we have to cover that in our training data.
Anyone else?
I mean, I'll just comment on that also. You can also, this is just sort of a general machine learning tip, I can describe it. If, let's say you build a model and it is dominated by one factor when you have that available. What you can do is just delete that factor, retrain the model, get something else with lower accuracy, and then build an ensemble of the two models. And this is typically a way to handle it. So you use one when it's available, the other one. You still have to evaluate the thing as a whole, find its ROC AUC, find its precision recall, whatever. But so the point is, when you build this combined model, you still have to evaluate it the same way you would evaluate a single model. But that is typically the way you would handle situations like this. I mean, another thing is there's imputers of various sorts in your favorite machine learning library. Go with the average if the value's NAN. So you can always do that kind of thing as well, depending on how important it is or not.
So fundamentally, in any loan business, it's that risk in your loan and the risk within your interest component, which you assume it's being written off, which is ultimately going to eat into your margin. And the figures in the US can be anywhere from 1 to 3% on, say, on average an 18% interest rate. The question is to arrive at that in terms of how much of your capital is at risk. Just knowing the default is one element of that, right? Because you said default is non-payment in 90 days. But that doesn't translate necessarily into how much recovery you make. And so the question is, I think we've been focused on machine learning or data science for default prediction, but are there other use cases in order to get a much tighter handle on that capital at risk beyond just merely default prediction?
So there's a number of things you can predict. I mean, one of which is, so FICO is basically attempting to predict delinquent on at least one loan after 90 days. But there are other models. So when I was sort of describing the, depending on what specific lending you're doing, how people will pay off their house first and their medical bills last because they don't want to lose their house, whereas the hospital can't repossess their repaired heart. So typically these things get input into the model, and so you make these adjustments you make to, let's say, FICO are often based on exactly things like this. Additionally, there will be, if you can additionally attempt to predict, let's say, recovery after 180 days, and if that is non-zero, you multiply it by the time value of your money. So all these games go into actually pricing a loan. And people who are making much bigger and longer term loans than I am will be much better at it than I am.
But is it just default and then recovery expectation, those two factors? Or
No,
other
it,
factors?
it depends on the kind of loan. So in the US, if you're talking about like mortgage lending, there are other risks, like there's interest rate risk, which is to say that you have let's say a 30-year loan with a certain interest rate, so it has a certain value, but if interest rates go up above, then that reduces the value of your loan relative to just treasury bills that you might buy today. Another thing that happens in the US, so the US has a really weird structure for home loans. It comes with an embedded option that you can actually pay it off all at once if you want. So this is called prepayment risk, and what can happen is, let's say if interest rates drop significantly, the borrower might take out a new loan to pay off the old loan, and then suddenly they're paying lower interest rates and you get nothing. So that's called prepayment risk. That is another major factor that goes into home lending in the US. I don't believe it works quite the same way here.
No, prepayment works here.
Prepayment works?
Yeah.
So you get the embedded option, but durations are also typically not 30 years, right?
Yeah, 30 is unheard of, but 20, 25, they usually give it. But there is also a charge saying that if you prepay within a certain thing, you have to lose. There's a penalty associated with that.
Yeah.
That's how they normalize it.
So the penalty is probably carefully calculated, and it's basically what you would lose.
Yeah.
In the US, you don't actually have those penalties. I thought some of them were also balloons here, right?
Yeah. Yeah. Okay. So the other question that I had for you is, when you're using alternative inputs, is it like a single factor that has predictive values, like location, or is it like you need a lot of factors to come and say, this is good enough?
So again, I can't review much, but from our data, we can extract up to 10,000 features, and we run a process of machine learning to reduce to about 100 or 200 factors that are most useful. So basically, if you ask the question that whether we can decide which factor will affect the outcomes of the credit scoring, then I think I can't give you an answer, because machine learning models work as sometimes it works as a black box, and there are many factors inside that interact with each other that we can't actually give you a clear answer that which factor will lead to the result.
Okay. The reason why I asked it is because when you start off, right, you start with heuristics. You just keep improving upon it, and at some point of time, your heuristics still work or it doesn't.
So I think in terms of our situation, sometimes prediction with a very good performance is not a good choice, because in that case you can come up with the overfitting problem with your training data. So we try to balance between our prediction performance and the performance in the real loan that we are taking with the bank.
Okay. Fair enough. Any other questions on alternative sources and models?
Can you explain the last point?
So we are running into some situation where if you train a model, even though you don't see the test data, you sometimes you tune the model and you can gain a better performance on the test data, but you unconsciously tune the model that it overfit to your test data, even though you don't fit your test data into the training process. So that's why I'm saying that we can run into the problem of overfitting even to the test data.
What if you take another test data and check again? That's an
Yeah, we have to figure out how to balance that.
How do you do that? How do you know you are overfitting or not?
I think I can't read much, but we have to run backtesting very frequently.
And the other question I had, when you do this AI ML techniques, the first time you don't know what your features are, you're going to do some approaches to find what they are. But as you get more data, if you rebuild the model completely, your features will change. So what kind of efforts do you take? Are you okay to shift your parameters, or you do it in a way that's incremental, and how do you rebuild the entire model?
Yeah, I think we have to accept the fact that if we train a model and then we use that like for a long time, it's not going to work. Because our data are going to change, and the way the customer behave and the way data evolve is different. We will change differently. So we have to change the model. We have to train the model. We have to fit it again, and we have to do that regularly.
So what is the typical revision frequency?
Probably 6 months.
And when you redo the model, you will still consider your entire history, or you'll throw away some of the old data and.
We have to balance between how much you cover and the performance of your model.
Does the answer change for you, or?
I mean, we train much more frequently. Basically, the simple cycle is you pay the bill twice a month. So we basically train that frequently. One other thing I would mention is that, at least for us, there is kind of an adversarial nature to this as well. So essentially, there's first of all ordinary underwriting we're doing, just trying to determine if you personally, this real person sitting in front of me, are likely to pay your bill as a good credit risk. And there is separately the fact that you're not actually a person sitting in front of me, you're a person out there in the world sending signals to my server somewhere. You might be shocked to discover there are people out there who will just attempt to do this over and over again, take out $1,000, take out another $1,000, try to get a bunch of free food, that kind of thing. So another aspect of all of this is we have to, whatever we're building, we also have to just be careful that some human won't be able to come up with an adversarial attack on it, and then, oh, where did that lack go?
What's your benchmark for the Gini and the EC metric that you might be using?
For the what?
For the metrics that you might be using for the credit scoring models.
What do you mean?
What metrics do you use for the credit scoring models?
So it's some combination of ROC AUC. We also just focus on I'll take lower ROC AUC if I can accurately get also calibration, and also since it directly affects our growth, just finding how many people are actually in the good set. So I'll lower my ROC AUC if I just get more people that are definitely less than 10% or 20% risk.
I see yours is more like a lending business, a credit card business.
Yes.
Twice in a month payment model.
Yes.
So do you have any banking ecosystem supporting you? Do you have it in-house, or is it?
It's all in-house.
All in-house.
Yeah.
Okay. So how big is, I can ask, what is the size of the data you work with, or how big is your customer?
I don't think we've publicized that.
Okay.
So how do you handle the regulatory things?
So we're in a weird regulatory position, but I don't know the full details of it. We are not an NBFC. We are.
So whose book do you lend in?
We are technically lending off another NBFC's book, but I believe it's not exactly a loan. I'm not a lawyer, and I don't know those specific legal details. So, sorry.
Which markets do you serve other than India?
Just India right now.
The same questions about you?
Vietnam?
So Trusting Social started our first service in Vietnam, and we extended to Indonesia, and now we expand to India, and there are a few other countries that we are heading to. Yeah.
Can you help us understand your name is Trusting Social? Can you elaborate a little bit on that?
So we, as I said, our whole point is using alternative sources of data to do credit scoring. So the way we do is we use social interaction data as the alternative source of data. So that's why we use that to do the credit score, and that is something like trustworthy of the person, right? So that's why we named the company as a Trusting Social.
But by social, you mean Facebook, WhatsApp, that kind of thing, or any other data?
Any other data that is considered as social. let's say your friends or anything can be called as social, right? It's not only the social media.
Sure.
So do you guys have like different models for predicting default and like for the accounts? Means once you are signed up, whether it's limits will increase.
Sorry, can you repeat the
So
question?
like different models for predicting defaults versus like once you are signed up, increase their limits or give them benefits.
So at the moment, we consider each loan application separately. So we assess that credit score when they make the application.
So don't you increase limit once someone comes on board? So don't you, if you have a limit history, don't you go ahead and increase their limit?
So because we do not provide lending platform at the moment, so we are not running into the business of increasing the limit. The bank, the financial institution will do that.
Okay. Our question was, do you have such policies in mind, or do you think that's how that should be?
I think that applied to Simber.
Okay, we do give credit bumps. Typically, if you pay your bill on time regularly, and also you look like you don't have enough credit. So, like if you run out of credit on day 5 of the cycle, it's a 15-day cycle. So if you run out of credit a lot on day 5, probably a bump is in your future. Assuming also our model predicts you're likely to pay the bill after you get the bump.
Is it like model-based or?
It's model-based. So it's model-based predicting whether you are likely to pay the bill, and then, I mean, I can call it a model, but it's based, like, in terms of whether you, so there's 2 questions. First of all, if I give you a bump, are you going to pay the bill? And the second bit is, do you even need it? Like, if you have a 5,000 rupee limit and you're spending 600 bucks a month, you know, why would I give you a bump? That's just risk and you're not going to actually transact, so why bother? So that is a really simple model. It's basically just sort of, you know, are you really spending anything close to your limit? And if you are, sure, we'll give you a small bump. And if you spend close to the new limit, you might get another one.
What is the documentation you expect to extend credit line? Aadhaar?
Nothing.
Okay. I just sign up in.
I mean, we'll ask you like your email address once you install the app and that kind of thing.
And then what is the typical credit line like?
Typical credits can be a few $1,000 bucks.
Okay, it's not differentiated based on the credibility. It's everybody's uniformly 2,000.
No, so so basically we're sort of a longer term relationship. So we'll start you off probably not very high,
Okay.
and then as you pay your bill and as you start to hit your limit or come close to it, then we'll start giving you bumps.
So you're not bound by RBI rules and regulations. You run a banking system effectively.
I don't, honestly, I'm the wrong person to answer about the specific regulations. I know we have lawyers, and every so often they say, you can't actually do that, and I don't do it.
Okay.
So in credit risk modeling, previously banks were using logistic regression, then comes the age of gradient boosting. Now what is the cutting edge algorithm which you guys use in credit risk modeling data, like say, credit bureau data?
So I think I can't actually name any specific model that we're using.
Algorithm, like deep learning.
Yeah, we try a lot of models, and we have to figure out which model works in which situation, and we can't name that specifically.
How important is interpretability of the models that you are building? So, like you said, some of them might be deep learning models and might be black box. You won't know what's happening. It's just giving you some validation score is good. But is interpretability important? Like tomorrow it might not work, and you have to figure it out. So it's not working.
I think in our case, interpretability is not so important. As long as our model works, then we accept that.
Yeah, I would tend to concur. Like, Rock AUC is something I can turn into money. If the Rock AUC is not high enough, we lose money.
Yeah.
Interpretability, it helps me debug the code, but on the other hand, like the interpretable models are rarely going to perform as well as the complex black boxes. So.
How do you provide the regulation in case the customer comes back asking like why I'm not eligible? Let's say the customer has been eligible and suddenly he is now how do you provide the reasons? Do you say like your score has been degraded, or you provide the exact reasons like why we are lagging?
We don't provide exact reasons.
Don't come back to it.
So we probably can't do business in Europe, at least not yet.
From an implementation perspective, you may not want the interpretation to be true, but let's say going forward in business, you want to attack a particular dimension. Do you want to cut the model, see if this model actually works in this dimension and not this dimension? In those senses, you need interpretation, right? For example, just to elaborate, let's say you want to probably going forward, you want to lend only for, let's say, food business or something, and you know that some features wouldn't be relevant if I'm typically focusing only on the food thing. So you need to cut the model across some dimension and probably see that small microscopic thing, right?
So to answer this question, I think I can refer to the interview that Jeff Hinton, father, he can be considered as the father of deep learning. In a recent interview, he said that if you can explain a model, then you won't actually need it because it's so simple. If it's that simple, then you don't need a machine learning model.
I'll also sort of describe a little bit just sort of about how these things are often built in practice. So there's lots of pieces of it that are interpretable. Like for instance, there's sort of a whole library of things we've seen fraudsters do, and here's some code to detect when someone is doing that. So most of these are sort of interpretable because we know what the guy's trying to do, and we know how to spot it, and it's relatively straightforward procedural code that basically looks for that specific pattern and fits a few params. Okay, then these things feed into another model that is much less interpretable. So there's very often interpretable pieces of a model that then feed into a big black box that mixes everything together. So the interpretable bit might say, I think there's a 40% chance that this guy is doing this fraudish thing. And then there might be another piece that is also fairly interpretable that is, I think there's also another 10% chance he's doing this other thing, but I'm not really sure. And then the big meta model also says, and also he's from a suspicious area, and I wouldn't block him on the basis of any of these things by itself, but putting it all together, it tips him over the limit. So this is sort of how a lot of things are engineered in practice. And then typically most large models will have various submodels that are dealing with one piece of the data. So like we might have a thing that sort of deals with, like we have one thing that just deals with email addresses. Some email addresses are more suspicious than others. And like that's kind of interpretable, still a bit of a black box, but at least we know what goes in, what comes out, and this is about this part of the data, this model's about this other part of the data, and then they all feed into a much bigger thing at the end of the day.
So if the government enforce some regulation that require you to explain the reason why you reject a loan, for example, then I think sometimes we have to make up the reason. And it's not a real reason that we understand, but we have to make up to answer that.
Okay. Specific examples on made up reasons? Okay, right? So I had an example on 2009 when Citibank actually said that basically I got into a dispute with Citibank with a credit card score, and one of the hard problems that they had to explain to the government as part of the dispute was they basically linked some other person's identity with my credit scores. Okay, so the point is, in the court I argued around it, they basically said it's a severe technical error, and it went on for about half an hour, and at the end of it the judge said, you know what, I don't think you guys understand what you're doing, right? And so I'm going to award the case to him in 5 minutes if you are not able to explain it, right? So it's in India. It's my personal case which I argued before the judge. Okay, that was in 2009. And the side effect of that thing was that for 3 years I couldn't open any credit card or bank account because until that time my credit score was locked as due and stuff like that. So, right?
So they screwed you.
In some form, but I got the money back. I got the money back, and I probably also made them pay half of my home loan as a mental thing and all stuff like that. So it got resolved. So the key thing about interpretability is it's really not important for the fintech companies to do it unless until there's a law which says that thou shalt say it. Okay, and I think that is the part that is important. So that's why I'm saying you can't do business in GDPR, EU area.
Yes.
Yeah.
Or put it this way, if we did business in a GDPR area, We would just have to charge much higher interest rates to deal with lower accuracy.
Right? So that's the price of interpretability and why you're seeing this. And there isn't much you can do about it. It's either this or more interest rates.
Yes. Or similarly, like in terms of the same trade-off is there for privacy. If we take no data about you, we have to charge you the average of you and all the fraudsters that are also saying, I want my privacy. And that might be a lot.
Factor in life expectancy. Yours are all much T-based kind of thing, so life expectancy does not figure much into that. Same thing with you as well. When I take a loan, possibly I die.
I mean, maybe he faked it.
I don't know. I think that is too specific and it's too rare to be considered.
So you basically, I think his question is that do you insure the credit? Like when they sell credit card, they have an insurance for every credit holder for the amount of credit. They go for an insurance policy for the amount of credit.
It's the larger loans. So when you take a home loan or a car loan, you're supposed to insure the amount through another insurance policy.
And even for credit card, they do it in India. To whatever credit line they granted. Yeah, it's not an individual one, but a group policy kind of thing they do it.
Let me ask you, yours is a much smaller amount for a smaller duration. I don't know what is your duration and your amounts.
I think it depends on the loan, but probably 12 months or 24 months, something like that. But if you ask me about those questions, I think I am not the right person to answer because I don't know much about the business, how the business is going. So.
That's why I asked the question interpretation. Basically, as a data scientist, we don't care if it's interpreted. It works like a charm, and we don't have to explain why it works. It works for us. But they generally want to slice and dice and ask questions and all of various dimensions. That's when you need the interpretation.
No, I think the interpretability is very important or not important as long as they meet the goals, which is like, I think you start by saying that this is the amount I will maximum lose or I will maximum gain or something around that.
Yeah, we typically focus on like how much money we are likely to lose. And I mean,
as long as you lose much less than that, I think you don't really care.
Like put it this way, the business guys always ask these questions and ask if we could give something. They don't use the word interpretability specifically, that's a technical term, but they want to know more about what's happening. I'm like, look, I can either give you less accuracy and we'll lose more money, or you can just sort of accept, or you can read this paper on gradient boosting or neural networks or whatever. I mean, ultimately at that point, that's the trade-off, and you explain that to them, and they never read the paper on autoencoders.
We generally fall short of giving that.
I mean, it's simple. I'm mostly also running that knob, so.
For your case, is loan duration also something which the model predicts? Like depending on, I mean, it might not be possible to actually give back a loan in a certain duration for a certain individual. Is that something which also is like for each individual you try to predict what duration this guy will be able to give back?
I think our model works in a bit like higher level. We're not building into that specifically, but the model is like, we are not saying about like 50 or 100 different models, right? We're talking about like 5, 10 different models for different products, but we're not building models, let's say, predicting the repayment after 12 months or 24 months. We don't go to that specifically.
But I can tell you that people who do issue longer duration loans do worry about these things. But mainly I just know this because my wife builds graphical tools for them to actually like understand this. So like, for instance, there is a thing called credit score drift. Your credit score is predicting your delinquency over the next 90 days on some loan, but also your credit score might just go down or up over your lifetime. And in a larger pool of loans, it'll go both ways for different people. So there's typically sort of a random walk model to describe how that happens. There's both random walks. You also look at what happened in the past and you project. And typically what you'll do is you'll come up with nightmare scenario, you'll come up with good scenario, standard drift plus more, and then you sort of evaluate what comes out differently in each of these cases.
that's the basically I mean that's the path of your credit score. But like my question is this that like whenever somebody, so there are two ways you can do this. You can say that okay, will this guy, like I'm giving him some loan, will he be able to pay it back for a certain duration? Like you'll have something in mind, like say 180 days or 6 days or 12 months or 24 months. Or you'll say just does he have a probability of paying it back in a large enough duration, something like this. Other way can be that okay, you fix the loan amount and now you try to predict okay, in what time will the user be able to pay it back given a certain historical data about the user. Is that something which is
Well, those are the same thing. It's just depending on whether you're, like, when you draw the graph, it's either going like seeing where the horizontal line slices this way or seeing where the vertical line slices, or if the vertical line slices.
right? So yeah,
This would be easier with a whiteboard.
Okay.
But they're basically the same thing. It's just a matter of like you're looking at it's either a
Yeah, I
horizontal line or a
understand.
vertical line in the same graph.
Yeah.
And if we had a whiteboard, it would be easier to explain that.
Okay. Snacks is over here. If you want, you can just take it, but keep asking the questions.
Question. You mentioned that you're on checkout pages for various merchants. Wondering if merchants do share any transactional data with you in terms of what customers are doing prior to checkout?
So typically what they'll share with us will be more like their gold, their platinum, their best customers. Because like what Symbol is primarily is a convenience product. You push a button and your lunch is on the way. You push a button and then you have your movie ticket. No OTP, no filling a wallet, nothing like that. So typically what they want to do is the customers who use their product a lot, who will make like 5-6 transactions in 15 days, they want those guys to be on Simple to remove the friction and make it go up from 6 transactions to 7. So they'll basically say this guy doesn't have a kitchen, he just orders his lunch all the time, and then they'll just pass that to us.
So it's like a selection that they do beforehand based on the route that you have shared with them, and then they see the Simple option on the checkout pages.
Yeah, like if you go to a movie once every 6 months and use Book My Show, and that's all the e-commerce you do, Simple is not a useful product for you. Just don't even bother. Whereas, like for instance, we're on some cafeteria merchants, so it's a corporate cafeteria, and you might go there for lunch and chai and sometimes dinner. That's a great simple use case. You don't have to deal with reloading your wallet when you just want your lunch to come. You just press the button, okay, you take your tray.
Do you do the alternate stuff even for companies and corporations, or is it only for individuals?
Sorry?
The alternate credit score models, do you do it for companies or private corporations, or is it only for individuals?
So at the moment, I think we focus in individuals.
Okay.
I can tell you a big player actually in doing it for companies, so in the SMB area is Stripe.
Ah.
Because if you think about it, Stripe knows a great deal about your cash flow. And they also have a great marketing platform. So a thing Stripe does, it's part of their business now, small business lending. Stripe knows your cash flow. They have a rough idea of what's going on. So when they decide you are eligible, you log into Stripe and they're like, do you have cash flow issues? Click here for a business equity loan subject to these terms, collectible against your Stripe payments.
So I also read about Ant Financial in China. So the way they do is they use data from their platform in Taobao, for example. And in Taobao, you can have another e-commerce of Alibaba. So it includes both small business and individual. So in that case, they know how well your business is going, like how many transactions you have done in the past 1 or 2 years, and who are your customers and things like that. And they know that you are doing well with your business. And in that case, they can approve you a small loan, like a few thousand $.
And for you to predict cash flow, you also need to know about the expense side of the stuff, right? For a company?
So Stripe doesn't know everything, but they also know some of it, because if you're paying from the account that Stripe knows about to another Stripe account, they don't know everything, but
okay.
at the very least they know a chunk of your revenues.
Okay.
And I'm sure they buy data as well.
Yeah. Okay.
Like this thing I know exists, I don't know exactly how they do it.
Okay.
But I do know they have this extra data point that no one else has.
Okay.
So going back to the gold star problem, I'm just curious, thinking out loud, that you generally, in the gold star, you generally have the problem of the typical exploration exploitation, right? Somewhere you explore and see what kind of people you meet, and somewhere you use the data to exploit. Have you guys researched or probably thought about using reinforcement learning in those fields and probably getting some results out of it? Just curious.
At the moment, in our product, we haven't used, but that is one of the directions that we are working on.
I'll also suggest that, generally speaking, the people you learn the most from, are the marginal people. The marginal ones. So if you have a score, let's say 1 to 10, and you find a good risk cutoff is 3, so let's say higher is worse, probably you want to approve like a nice little holdout set at 4 and a much smaller holdout set at 5. Probably going all the way to 9 is just a waste. And then what will happen is, like, you do this for a little bit, you discover actually it's pretty safe to go to 4. You repeat it at 5 and 6, and you do this until it blows up.
Okay, 6:30. We have another 5 minutes, or so you can keep asking questions.
So all the fintech lending companies where there is no human intervention and it's like auto approval process, it is prone to massive frauding attack. So are you taking care of that?
I would like to avoid fraudsters, yes. I'm trying to prevent them from getting in. Beyond that, I can't say much.
What all things you are using to prevent that? If it is allowed to.
All I can describe is the mindset. With a typical machine learning problem, if you're trying to differentiate cats from dogs, you really just focus on accuracy. If you are trying to deal with an intelligent adversary, you also have to think about, and in this thing I built, if I, let's say, know how this works, can I hack it? So it's a mindset you have to get into, and sometimes you'll discover, yeah, this seems to work great, but someone could scam me this way, so I'm just not going to switch it on. Or I'll switch it on, but in a limited form, and the minute someone figures it out, it's off. Like that's a mindset. It's a mindset you have to get into. It's half computer security, half machine learning.
Do you employ adversaries?
Yeah, we try to hack ourselves. We have a bug bounty, so if you figure out how to scam Simple, we'll pay you. You also get an automatic job interview, and we'll try to recruit you if you can figure out how to do it. Yeah, there's a kid out in Jaipur who got some really nice bug bounties for sitting at home playing with us. And
one thing I want to add about this is the way we consider machine learning. We instead of consider machine learning as fully automation system, we better combine whatever machine learning work well and whatever human work well. So we have to find a balance between the two.
And also just like, you have to be really creative when you're trying to think this stuff up. Like, here's an attack someone might make. They order groceries, if they figured out sort of a way into the system. They'll order more groceries than any human could consume, and they're turning around and selling them at a discount. Like, this is a thing. We actually discovered someone doing this.
But you generally offer very low limit, right?
But if they can do it over and over again, it's just amazing how much groceries are going to this one guy's house. So like these kinds of things happen, and yeah, if you're just like, oh yeah, I made the numbers go up and I haven't even thought about exactly how I could scam this, you're gonna get scammed. And the other thing is the numbers are gonna look great, great, great. Where did all that go?
Yeah, that's the black swan problem.
It is not so much a black swan,
Yeah.
It's just one asshole in...
Yeah, that's the black swan.
Somebody doesn't pay the simple bill.
We are actually sort of building, so we track it internally, we keep them out. There's some, so we're not actually part of Sybil, so it doesn't get reported to Sybil, but there's also some alternative reporting systems that are basically getting started. So basically, other alternative lenders may also not like you in the future.
What about you? How do you track and manage fraud?
If we are talking about the current business model, then that is basically part of the responsibility of the bank. And of course, we take part in that as well. But like at the moment, it's like we have to work with the bank on how to figure out those fraud.
Do you actually help the bank in figuring out the fraudster?
Yep, of course,
That's part
of course.
The
Let's say, as Chris said, we want to get rid of the fraudster, right? So before we advise the credit score to the bank, and if our fraud detection model predict that these guys are fraudster, then we just reject them.
Okay. Yeah, the fact that you don't have to offer an explanation makes it easier?
Yes, I think that's why we work easier in Asian countries. I think we have to find a good way to work in Europe or the US.
Okay. Yeah, I mean, additionally, like a lot of fraud signals are not going to be anything close to perfect. Like, there's a lot of things that are like a very strong prediction. Yeah, this guy's 50-50 chance he's a fraud. Now, obviously 50-50 is not a credit risk you can take, particularly when the guy's going to just keep doing it, and he'll make your entire portfolio go to 50-50. Yeah. But at the same time, like, that's certainly not going to hold up in a court of law that this guy's 50% chance he's a fraudster.
Okay.
And if you don't block those people, the whole network shuts down. That's it.
Okay. Any other questions? Last questions? 2 questions? All right. We're almost out of time. Thank you, everyone. Right. I hope you caught most of it in 90 minutes.
Yeah. Thank you.
Thank you. You can meet and talk to them, and it's still available for whatever time it is. Yeah. But, yeah. Oh God, this is definitely not the one that I want to put.